What if I told you there's a formula to getting the best possible hard money loan terms, even if it's your first deal? In this video, I'm going to go through the 3 key factors lenders look for, and I'm going to explain how you can best position yourself to not only get your loan approved, but to get the best possible rate and terms. So let's look at lender priorities. Let's go through the 3 factors that I believe a lender is really going to be looking at when evaluating your transaction. So before we get into the first key factor, note that there really isn't a particular order because they play interchangeably off each other, each of the 3 factors. At the end of the day, you're evaluating a deal in its whole, not necessarily in part when you're a hard money lender. And maybe that's because we have the flexibility and less red tape that a bank does, but it's why I love the business. And it's why we get deals done and why we can use common sense to close loans here at ABL. So let's talk about the first key factor, which is creditworthiness. And I'm going to put it in 2 parts, right? We're going to talk about credit score and we're going to talk about liquidity. So with credit score, the more experience you have, the lower credit score you need. If you got a couple deals under your belt, then you may only need to have a credit score of 660. If you don't have any deals under your belt and you're a first-time borrower, we might need your credit score to be at least 700. And why is that? Well, we know that the strategy may in fact be to buy, renovate, and sell, but with a higher credit score, you have a plan B in play where you can actually refi out through our DSCR program, or maybe go to a conventional bank and get the loan done there and eventually repay us. But basically, with a good solid credit score, you have the ability to exit not just via a sale, but also a refi. Liquidity is the other, I would say, key factor in terms of borrower financial condition. Liquidity can be the trump card to get a lot of loans approved. With low experience, but a lot of liquidity, taking on your first flip, we know that you have the room to make mistakes. So with liquidity, what we want to see is obviously you have the down payment plus closing costs, but we always want to see that you have a little working capital to go through a standard draw process, which we'll talk about in other videos, and to make loan payments, to be able to pay contractors, to be able to get reimbursed for work complete. The bottom line is a strong liquidity position puts you in a really great position to take on cost overruns and to mitigate potential downside scenarios that maybe you didn't see or we didn't expect, because maybe it's a first time in dealing with something like that for whatever reason. So, FICO, to a certain extent, matters. We have that minimum thresholds, of 660 on the downside for experience, 700 for me for first timer. But I've approved loans with borrowers with 585 credit with tons of experience and great liquidity. So bottom line is, when it comes to borrower financial condition, we're going to focus on credit and liquidity. A borrower should know to present themselves in the strongest possible light, because at the end of the day, if you're coming at us for the first time or calling at any lender for the first time, you're going to want to make sure that you check the credit box right out of the gate for the lender, and that you're aware of the fact that you're going to need a certain amount of liquidity, whether it's required by a lender or not, to simply execute, a repositioning of an asset like a fix and flip, or into a BRRRR as an example. Creditworthiness, the first of 3 factors that we're going to talk about here in this video today. So the next key factor is going to be the borrower's experience. We're going to want to make sure you have experience and we count and reward you for that experience. So if we're looking at a straight fix and flip, we're looking to get you the best possible terms. I'm going to ask you how many fix and flips you've executed on title where you either owned a percentage of the LLC or your name was on title as having owned a fix and flip where you bought, renovated, and sold within the last 3 years. We count those up. The more you've done, the better rate, the better leverage you get, the lower amount of origination fees or points you'll pay. The more experience I can get you on paper as qualifying experience, the better terms you're going to get all day long. And our rates will range from 8.99 up to 12 and anywhere in between depending on how experienced you are. Obviously, with more experience you have, there's less risk for us, so we reward borrowers for that experience. So I'm always going to come at you on the phone and say, hey, first let's get your profile built out. How many deals have you done similar to this on title where you can demonstrate that in processing? For now, we trust what you're quoting us. We'll get the loan approved. We'll price it out, on a verbal, in processing as a first timer, we'll verify. The other thing we count is experience where you've been on permit. If you're a contractor, you can demonstrate that you've been the contractor assigned to several fix and flips, several renovation projects, several new builds, whatever. We're going to count those. We're going to ask for you to provide evidence of those permits as part of the processing of your first loan with us. We'll onboard you, but we're going to reward you for all that experience here. So the fact of the matter is the more experience you have, the less risk we feel we have. That's going to increase your chances of getting a loan approved, of course, but it's also going to reward you with the best possible rate and terms. As a loan officer, I want to see you get the lowest possible rate. I want to keep you coming back. So the fact of the matter is if your first deal and you're coming at us and you're 11% and 1 or 2 points, and then you come to me your next deal, you're going to be at 10.5 most likely, and you're going to keep getting a better rate as you get more experience, and that's just common sense. And here at ABL, I think it's pretty obvious that we take a common sense approach. Experience is really an important factor, and it can really do a great job of getting your interest rate down as low as possible and making sure that you're getting the most leverage or putting the least amount down in the end to close on the investment. So experience is important. Make sure that you are forthcoming with your experience, at least in the last 3 to 5 years. We'll provide you with a schedule, the ability to present your experience as we need you to. So last, but definitely not least, is going to be deal structure. And what I mean by deal structure is loan to value. I mean debt service coverage ratio, and I could mean amount down. I could mean the amount of equity that a borrower has going in, or the after repair value versus their basis or total project costs. I can look at a lot of different ways, but at the end of the day, I think the foundation for hard money lending in history has always been, what's your collateral and what are we lending against it? If a borrower is willing to put more money down, that's going to mitigate risk. That makes your deal more likely to get approved, for you to get better terms, because ultimately, in the end, we're going to worry about skin in the game. How much do you have invested as a borrower? And then ultimately, loan to value, loan to cost, the leverage metrics. The more experience you have, the more leverage you're going to get. The lower experience you have, the lower leverage you're going to get. Same thing with rate and points. The more experience you have, the lower the rate. So we might go as low as 8.99% with somebody with 5 deals experience. Somebody with 1, we might be at 11. So you just don't. You want to make sure that, obviously, we're looking at the whole package, but going into the deal, we're going to be looking at, along the same thing as credit, liquidity, and experience, we're going to be looking at the LTV levels to make sure that we have enough cushion, and that, depending on your experience level, you can make mistakes and still get out, ultimately sell the property or refinance it. Deal structure is super important. Again, it's the foundation of hard money lending. We're always collateral-based lenders in the end. No one ever wants to foreclose on a borrower. It's not something that a lender wants to do. That's their ultimate fallback to getting repaid if they have to. Ultimately, that means that we want to have our loan amount at a certain percentage of the property's value, both on an as-is and on an after repair value basis, that gives us protection. And the lower that we are on that leverage scale, the better rate and terms you're going to get, the higher likelihood your loan is going to be approved, and so on. Deal structure is super important, probably the most important in the end, but I like that I put it third on the list because it's something that it needs to be discussed, and it needs to always be a factor, and it's something that as you present the deal to your lender, you're going to want to make sure that you understand the metrics, and we'll get into that in the next segment. So now that you know the key factors we're looking at, you need to present yourself as a strong borrower, one that's done their due diligence and that can tick the boxes of those 3 key factors. And so let's start with a simple email, a framework for a little loan package that is summarizing a loan request. We're looking to do a fix and flip of a single family house in Springfield, Massachusetts. The house is going to be purchased for X, is going to be renovated for Y. Post renovation, it's going to be worth Z. And I'm requesting that you fund up to 90% of the purchase price, all of construction, and you show that in the end, that loan request is maybe sub 70% loan to ARV. You put together the framework of the transaction for the lender. If you don't want to go ahead and calculate the loan amount and you want to leave it as just purchase price renovation, ARV, and a little narrative as to what's going on with the property, that's fine too. We'll take it from there. The other thing is you want to put in your credit score. You want to know your credit score. You want to know and understand what the property needs, not just a number. Don't just guess. We want to know that the property needs to have a new kitchen in order to sell at the maximum price in the marketplace because the other comps sold for that and they had new kitchens. Little things like that you're going to know not just about the project itself, but in what it needs, but also what it's going to sell for based on the comp set, and that the ARV is supported. You can have agents working with you. You can have contractors working with you. These are all things that you should have in place prior to going out, obviously having an offer accepted, coming to me with a loan request. So you're going to want to make sure that, again, you have the framework of the deal ironed out, a little loan package, an email. You know that we're looking for experience. You're going to want to put in a bullet point what you have for experience, list out the projects you've done. If you don't have experience, you're going to want to talk about why this is an executable project. Maybe you got it off market. You bought it from your aunt. You buying it at a great price. It only needs a cosmetic rehab. You want to highlight what you're doing is something that's within your skill set and explain how you plan to execute. Once you're able to put that together, the complete, start to finish of the transaction, you'll be able to get on the phone with the lender and really go through it with more confidence. And at that point, you and your lender will be operating under the same framework of the transaction. And by coming in prepared, the lender is 100% going to be able to respond that much faster. So not only are you going to try through a little loan package, try to present yourself as giving yourself credit for all your experience you have, or giving yourself credit for understanding the numbers, the framework for the deal, laying it out so there's nothing lost in translation, and explain how you can execute this deal will get the lender not only comfortable with you and the strategy, but it will also position you for a really good call, and it will speed up the overall due diligence process that the lender is going to have to do, because you're going to have it all there in a nice, clean, concise package followed up by a quick conversation that's confirming the information. And now we're that much closer. And, with companies like ABL, a nice package, a quick conversation, we're 80% of the way through getting your loan fully approved. We're approving loans in a day. So, that's pretty much the bulk of the work right there. So at the end of the day, our programs are built for speed. You just don't want to skip steps, because you're going to be the one that allows us to get through our process faster, smoother, with the transparency of a loan package. Gives us all the confidence of knowing that you know what you're doing, your performance is there, you know what the sale price is going to be, yada, yada, yada. The debt service coverage ratio calculates so that when you refi it out, the DSCR coupled with your credit gives you enough cushion for us to comfortably approve the loan to value that we're giving you on the rehab, and you're completing the picture for the lender. Ultimately, that completes the picture for the underwriter, and the project just sails through the approval process. Can't stress enough, be prepared. Have a package together and use that package to guide you and ultimately the lender through the approval process. Can you negotiate hard money loan terms like rate and points, leverage? And I'd say the answer is generally yes. I would say every lender has a floor. So I don't want to have all my top tier borrowers coming to me saying, hey, give me better terms. I think our terms are the best in the business to begin with. But the fact of the matter is if you do have experience, generally hard money lenders in the space will negotiate. Not all lenders can negotiate. So I have an experience ladder, and let's just paint a picture of my loan matrix. If you have one deal experience, you might have a rate of 11.5%. If you have 5 deals experience, well, you might have a rate of 8.99%, like I've said. Well, we have categories 3 to 4. We have 1 and 2. So leverage, rate, and points are all playing a factor in our pricing grids here. And with the right borrower who has the right credit score, the right experience level, and let's say is potentially doing business with a competitor or is getting better rate and terms elsewhere, let's just say, would definitely want to compete in that situation. And we have the ability to. Obviously, like I said, we can't go lower, but at the end of the day, if we're looking to win business, which we are, we're going to bring in borrowers who have experience, and we're going to do what we can to win that business. And a lot of local lenders, I would say, the private money guys, maybe the smaller regional lenders who go out and raise capital, not always have the ability to negotiate below their thresholds. I know a lot of borrowers who are still getting 12%, 2 points, 13%, 3 points, and even as high as 14% and 3 points in some cases. And while to me that makes no sense, the fact of the matter is that lender just may not have the ability at all to go beneath that, because they're promising their investors a certain return. We have access to cheaper capital here. That allows us to offer the low rates we do, as long as we're playing within matrix and we're competing. And so I encourage folks to speak up and see, and it can't hurt if you're prepared and you know what you're doing and the risk has been mitigated for whatever reason. It could be leverage, it could be anything. Maybe there's a higher likelihood of you getting that exception and that lower rate in that case. So I think some lenders are handcuffed. We're not. So bring it, and we'll see if I can't beat the competition for sure. So Mike, what's the secret? Well, the secret is to know what I'm looking for, to know what I need in order to get you the best possible terms. So we talked about it, right? FICO, liquidity in terms of creditworthiness. We have experience, which for me, depending on exactly the number of deals you've done, either on title or on permit, is going to dictate how low of a rate I can get you or how much I can lend as a percentage of the after repair value. And then finally, we're always talking about the overall deal structure. What's the LTV in the end? When all is said and done, your ability to put that in a nice, concise package, an email, doesn't need to be much, but just something that shows that even if you don't have experience, you know what we need as a lender to get through the initial underwriting, the pre-screening of the loan, and to get terms back to you as fast as possible. And by that, I mean a little email that's got a short little narrative that says, I'm looking to buy XYZ property. I'm going to do a fix and flip, and below are the numbers. Purchase price is X, the renovation is Y, the after repair value is Z. My FICO score is excellent at 750, and I have a clean, concise strategy in terms of the renovation, and I've talked to contractors, and this property only needs a cosmetic rehab of whatever. And you go through that, I'm able to pick that project up very quickly. I can tick all my boxes in my model, go through, and with a 15-minute call, I can present numbers to you and submit to underwriting and be on our way to engaging the appraiser into a closing. So not only are you giving yourself the best chance of getting your loan approved, but you're giving yourself the best chance of getting the best terms from your lender if you show that you're prepared, that you give them the tools in the toolbox to get your rate down, to get your leverage up, etc. And that's just by simply knowing what we're looking at, which I hope I outlined here in this video today. So if you enjoyed the content, please, as always, if you have any questions, comment. I'm responding quickly. And then, as always, I'd love it if you subscribe, because I'm going to be doing a lot of different types of content surrounding the hard money space, both from the investor side and from the lender side, that I think will definitely help you in the process of going out and really understanding the hard money industry or the hard money financing segment in general. So as always, I want to thank my sponsor, Asset Based Lending, and I look forward to the next one. Thanks.